So we've prepared the journal entries, and now what we're going to do is we have to post the debits and credits from those journal entries to the affected T accounts. So if you look back to the beginning of the problem, there was a beginning balance in the common stock account of $1.6 million. So we have to put that in there. And then on July 31st, we had credited common stock for $240,000, so that the ending balance for common stock is $1,840,000. For paid-in capital in excess of par on January 1st, we had a beginning balance of $240,000. And on July 1st, we had credited the account for $60,000, so that gives us an ending cash balance. An ending paid-in capital in excess of par balance of $300,000. If we look at the cash dividends account, we had a declaration on February 1st, another one December 1st, so the total cash dividend is $172,000. In terms of stock dividends, we had debited stock dividends for $300,000, so we have to post that. If you look at the common stock dividends distributable, originally, when we declared the dividend, we credited the account, but those shares were then distributed to the shareholders, so we debited the common stock dividends distributable account for $240,000, which brought the balance down to zero, and we increased the common stock account by $240,000. Alright, so if we look at the retained earnings account, we're given a beginning balance of $750,000. Net income, which increases the account, is $500,000, so we have to credit retained earnings for the net income of $500,000. We've said that dividends decrease retained earnings, and that includes both cash dividends and stock dividends. So if we look at the stock dividends account, we have a debit there of $300,000, so we have to put the debit into retained earnings. And then in terms of cash dividends, we have a debit of $172,000, which also has to be reflected as a debit in the retained earnings account. So to come up with the balance from retained earnings, we add the credits, which are our increases. We add the debits, which are the decreases, subtract the debits from the credits, and that would give us our ending balance of $778,000. So now that we have the balances for the stockholder equity accounts, we can prepare the stockholders equity section of the balance sheet. Alright, and here it is. We list paid-in capital first, and this is pretty straightforward here. So under capital stock, we only have one class of stock, and that's common, with a $20 par value. That did not change, and 92,000 shares issued and outstanding. Once again, it's the original 80,000 plus the 12,000 from the stock dividend. So the total value, as we already saw in our T accounts, is $1,840,000 in common stock. The additional paid-in capital in excess of par, we take the $300,000 balance that we got in the T accounts. We take the common stock plus the additional paid-in capital, add them together. We have total paid-in capital of $2,140,000. Last, we take the retained earnings balance of $778,000, add that to the total paid-in capital, and that gives us total stockholders' equity as of December 31st, 2017 of $2,918,000. I'm sorry this gets split up into two different videos, but of course I will give you both and you can review them. and then you'll have the actual documents that you can look at as well.